Yes.
All right. So we started last time in chapter 10, finance and accounting, and I gave you the outline for chapter 10. And the last time we almost completed section 10.11, which is a statement of profit or loss. A statement of profit or loss, as we discussed, is one of two key financial statements that we are going to look at. At a more advanced level, you're going to be introduced to more financial statements like the statement of cash flow. But at your level, we are limiting ourselves to two key financial statements, the statement of profits or loss, which is also called the income statement, and also the statement of financial position. Now, even though we said that there's no definition of what a financial statement is in our textbook, it is good to get an idea of what it is. And I drew parallels with the report of a student. And I said that a financial statement is a document or a report that presents the financial performance and the financial position of a business at a certain period, for a certain period, which is usually 1 year. And even though financial statements are usually prepared at the end of the year, they can also be prepared at the end of a month, the quarter, or half of the year. Now, two very key important keywords in the definition is that it's a document or a report that shows the financial performance and the financial position. Now, the statement of profit or loss is what shows the financial performance. And with financial performance, we are interested to know whether the business made a profit or a loss. So we're not going to go through all of that again. Let's just pick it up from where we stopped. And then, yeah, let's pick it up from here, where we looked at Rolls-Royce. We said that it is a very big company that manufactures engines for aircrafts and also ships. And then we asked the question, analyze one reason why Rolls-Royce employees may be extremely concerned about the company's financial performance. And rightly so, you said that they will be concerned because of their wages, yes. So this is a more detailed answer. Like I said the other time, you would be expected to give a more detailed answer. You mentioned their wages, which is the second point here. Um, Let me use my highlighter. You mentioned to keep their wages. All right. So that point, when you expand it a bit, it says that the company may seek to control its costs. One of the costs of the business is the cost of the wages of these engineers who manufacture the engines. And because they are highly skilled, their wages are very high. So the company may seek to control its cost. I'm reading its cost of sales um, tightly in the years after these accounts. All right. Its cost of sales has risen quickly, reducing the gross profit, even though the revenue has risen. So the revenue of the business is good. We looked at I think in excess of some 15 billion in one particular year. However, its cost of sales is very high. One of the cost of sales is the wages, and then the company will seek to reduce the wages so that they can make a good gross profit. I continue to read. So the company may keep wages low to restore future profitability. As its employees are highly skilled workers, its labor cost could be very high, and paying wage rises could be costly. Therefore, employees may not receive pay rises, reducing their standard of living. And then the first question or the first reason, the question said give only one. So the wages is enough, but we could also talk about the staff being redundant, the engineers being redundant. So it says the employees may depend upon um, the company for their incomes. If the company performs poorly, their jobs become less secure and they may be made redundant. And they may be made redundant. Um, so it says the employees could be made redundant, and the company has made very large losses both in 2018 and 2019, and employees may fear that jobs will be cut to improve its financial position. All right. And then another question that was also asked, that is the question two, was is evaluate whether or not Rolls-Royce's shareholders would have been pleased with the company's performance or not. Whether or not Rolls-Royce. Now, I gave you these what we call important words. I've forgotten the term they use for it. But when it says analyze, when it says calculate, when it says evaluate, you are looking, especially when it says evaluate, to look at the positives and also the negatives. All right, calculation is very straightforward. When a question says you should calculate, but when it says you should evaluate, then you should present a balanced opinion, the positive side and the negative side. So a response to this second question could be as follows. So question two, it says there are a number of positive factors. So let's talk about the positive factors first about the company's financial performance in 2019, especially when we compare the financial performance of 2019 to 2018. Its revenue rose substantially. The revenue in 2018 in 2019 increased from the revenue in 2018. So its revenue rose substantially between the 2 years, increasing by 858 million, suggesting that the company was successful in selling its engines and other products to customers. Similarly, shareholders may have been pleased to see that the size of the company's losses fell sharply in 2019 compared to 2018. So these are the positives. Revenue increased, the losses decreased. All right. So this was achieved despite not receiving a tax rebate of 554 million, suggesting that the company's underlying performance was much improved. However, so this is the other side, the negative side of it. However, there are still worrying signs for the shareholders of Rolls-Royce. The company still incurred a large loss of over 1 billion pounds, and it appears to have been trouble. It appears to have trouble controlling its cost of sales. So these are the worrying signs. So we talk about the positives, and then we also talk about a bit of the negatives. He continues to say that this trend, which could be very damaging to future profits and the company's share price if it is not corrected. Then the last point, it says whether shareholders would have been pleased with the company's financial performance in 2019 may depend on the shareholders' approach to investing. If these are shareholders who are looking for short-term benefits, then they will not be happy looking at these losses. But if you look at the revenue that the company is bringing in, if costs are controlled, especially the cost of sales, and if other costs are controlled, then it could be able to wean itself gradually from making losses into making profits. So, depending on the approach that the shareholders take to investing, that will determine whether they will be happy about the performance of the business or not. So, these are suggested answers for the question that we looked at in the case study involving Rolls-Royce. All right, and then we also looked at how a business might use its profit. We talked about distributor profit and we talked about retained profit. Did we talk about this yesterday?
I don't think so.
Yeah, I think we did. Look at the video again. I think we did. All right. I
Really?
think yeah. All right. Well, let me go through it quickly. How a business's profits might be used, how a business might use its profit. We said that profits can either be distributed to the owners of the business as dividends. So we can either distribute the profits to the owners of the business as dividends, or they could be retained in the business. The profits could be retained in the business and used for the purchase of assets in the future. They could be retained in the business and used for the purchase of assets in the future. I think that you would find this in last time's lesson. All right. Then we made a point that profit distribution should balance short-term shareholder satisfaction with long-term business growth. Yes, I do remember it now. If you want to um, look at it again, you can just refer to that video because I think
Okay.
I gave a good explanation as to how a business can use its profits, whether it will distribute the profits or to retain the profits. Where we actually stopped is this case study, which is the West Kericho case study. The West Kericho case study. And I'm surprised I don't have the question on this slide, but let me quickly refer to it and then we can look at it because it's very important that we look at this case study. It is helping us to understand the points that we made here, the factors that can cause changes in the statement of profit or loss. All right. So the profit or loss statement or the statement of profit or loss is looking at whether the business made a profit or whether it made a loss. And we're looking at what are some of the factors that can affect the profit or what are some of the factors that can affect the loss. What are some of the things that can increase the business's profits or decrease the business's loss, or what are some of the factors that can decrease the profit and increase its losses? And we said one of them is a change in the selling price, a change in the selling price, such that if we are selling say bottles of water and we have 50,000 bottles of water to sell and we are able to sell all the 50,000 bottles of water at $2 per bottle, then it means that the revenue for the business is 100,000. That is 50,000 bottles times $2. However, if we change the price of each bottle, previously, if a bottle sells for $2 and we change the price to $2.5, that means that our revenue is going to go up from 50,000, which we calculated by multiplying 50,000 bottles by $2. Now, because our selling price is $2.50, and we are selling 50,000 bottles, that means that we'll multiply 50,000 by $2.50. And that would increase our revenue from 100,000 to 125,000. And if our revenue is increasing and all things are equal, that means our profit is also increasing. And that will cause an amendment, a change. That will cause an amendment or a change in our profits. What caused this change? A change in the selling price. A change in the selling price. Also, if there is a change in the volume of the product sold, we could also have a change in the profit or a change in the loss. All right. So if previously we were selling 50,000 bottles and we increase the number of bottles to 60,000 at a price of $2 or $2.5, then it means that our revenue is going to increase from the previous amount of 125,000 to 150,000. And if you could draw a calculator close to you, it will be helpful because our previous selling price of $2.50 was multiplied by the previous volume that we were selling, which is 50,000. So $2.5 times 50,000 bottles will give us a revenue of $125. So if at a volume of 50,000 with a price of $2.50, we are making a revenue of $125,000 and we increase the number of bottles to 60,000, we are not still going to make a revenue of $125,000. Our revenue is going to increase to $150,000. And if our revenue is increasing, that means that the sales figure on our income statement is also going to increase. If our revenue is increasing, all things being equal, that is, if our cost of sales is equal, is the same, and our other overheads are the same, or our other costs or expenses are the same, that means that we are going to increase our profits. All right. So we are looking at these factors that causes an amendment or a change in the statement of profit or loss. And the last one is change in cost. All right. So if our administrative cost is increasing or our distribution cost is increasing, that means that our statement of profit or loss is going to change in form. Either our loss is going to reduce, or our loss is going to increase, or our profit is going to increase, or vice versa. Then the last note here says that adjusting the product sales, that is changing the volume of sales or changing the price of the product, can alter the costs that the business incurs, including the cost of sales and also some administrative costs such as distribution costs. All right, so let's look at the case study. The West Kericho Estate case study. The West Kericho Estate is a well-established tea plantation in Kenya. It has recently prepared a draft of its statement of profit or loss for the year, which is shown in table 10.2. All right, so I think I have the table here. Actually, I don't need to go and open our textbook. All right, so this is a statement, West Kericho statement of profit or loss, and these are the original figures. All right, so let's look at some of the things that will cause this statement to change. Before we do that, let's examine how the statements look like. So we have a revenue here. They are selling 112,400 kilograms of what's the product again? Tea. All right, so it's a tea plantation. So they are selling 12,400 kilograms of tea, and this is the price per kilogram. The price is $275 per kilogram. And its cost of sales for the 12,400 kilograms is at $160 per kilogram. So the price or the cost for each kilogram of tea is 275. How much did it cost the business to provide or make available the tea or to produce the tea? So the cost of sales, which is the cost of all the costs incurred in growing the tea, the cost of paying the workers on the plantation, etc. That represents our cost of sales. And for every kilogram of tea, it costs the business $160 to produce 1 kilogram of tea. So its cost of sales is put in bracket. That means that's a negative figure, or we are subtracting from the revenue is given here. So the figures are in dollars. The first figure is $3,410,000, which represents the revenue. And then the cost of sales here is $1,984,000. So if we subtract the cost of sales from the revenue, it gives the gross profit. So $3,410,000 minus $1,984,000 will give a gross profit of $1,426,000, and then which represents our gross profit. And then other costs are deducted. So administrative costs and other expenses are deducted. It's also in brackets, which tells us that it's a deduction or it's a negative figure of $878,000, and that leads to the operating profit of $548,000. And then there is finance income, that is interest received. Because we said that it is not an operating activity of the business, we don't add it to the operating profit. We don't add any income that is received which is not part of the operation of the business. The operation of West Kericho Estate is a tea plantation. It grows tea and sells tea. So if it puts its money in the bank and gets an interest, which is interest received, it is not added to their operating profit. So it is given a separate line on the income statement. So that amounted to $12,000. And then it also paid interest. Perhaps they took a loan from a bank and they are paying interest on that loan. So the interest paid is not part of the operation of the business, but it's a cost to the business. So it is given a separate line on the income, on the statement of profit or loss. And then that is also put in brackets. It's a negative figure. So of $36,000. And then that gives the profit before tax of $524,000. Taxation to the government is at 25%. So that is also deducted, and it gives the profit for the year, which is $393,000. What happened to these profits? These profits, some were distributed to the owners of the business. So dividends were paid. The dividends paid amounted to $136,000, and then they retained $257,000 in the business. And this is an amount of money that the business can use to finance the purchase of assets or use for other investments to grow the business. All right, so let's look at some of the changes that occurred, which is giving rise to these amended figures. The first one says that the company actually sold 12,500 kilograms of tea. So that is a factor that can change the structure of the income statement. Remember that we said these are some of the things that can change the structure or cause amendments in the statement of profit or loss. So if the actual quantity of tea sold was not 12,400 but 12,500, that should mean that the figure for revenue should increase. So instead of 12,400, which is captured here, if we use 12,500 kilograms to calculate the revenue, it will give us a different figure. All right, so that's the first change that you should take note of. The second change is that it says the selling price of its tea averaged $280 per kilogram. On the statement here, it is at $275 per kilogram. So that is also another change. So now in calculating the revenue, it's going to be 12,500 kilograms. And I hope you have your calculator. 12,500 kilograms times $280 per kilogram. So 12,500 times $280 per kilogram. And that will give us what? $3.5 million. That will give $3.5 million. So you see that the revenue has changed because some activity changed. They realized that the quantity of tea that was sold was not 12,400 but 12,500, and also the price per kilo also changed. Then it says the third point here says that its administrative and other expenses were actually $901,500. $901,500. So let's look at the statement again and look at the administrative and other expenses. Previously, it is quoted at $878,000, but in actual fact, it was $901,000. So this is an increase in cost, and an increase in cost will reduce our operating profit. All right, the cost here is less than the cost here. So if the cost here is more, that means that our operating profit will reduce. However, you can see that the net effect is that the operating profit is still greater than what it was in the original figures. Why? Because our revenue here increased to $3.5 million. So that could account for why the operating profit is still looking positive or recording a positive change. All right. Then it says that the interest rate charged on the company's loans rose, increasing its interest charges by 20%. All right, so let's go back to the statement. This is the finance cost, the interest paid for the cost of finance. Requesting to start meeting summary. Should I start or should I decline?
Please start.
I should start?
Yes.
Okay. All right. So, yes, the finance charges increased by 20%. So the interest on the loans that the company procured is not what is quoted here, 36,000 plus an increase of 20%. And if you punch that on your calculator, it will give you 43,200. So generally, what we are looking at are these changes. Well, let's look at the last one. The company's directors decided to increase its dividends to increase the dividend it paid to 175,475. So let's look at that change. Dividend paid here is quoted as 136,000, but here we are told that it increased to 175,475. So we can see the change here. And if dividend paid is increasing, that means that our retained profit would reduce. So we have a retained profit here of 250,000, which is a reduction from the 257,000 because of the increase in the dividend payout to the owners of the business. Any questions so far? We are looking at things that can cause changes or amendments to the statement of profit or loss. Any questions so far?
No questions so far.
All right, let's go on. Let's look at our last but one slide before we go to our actual lesson for today. The impact on a business's profit or loss, the impact on a business's profit or loss of changes in cost and prices. Basically, what we looked at in the case study that we just looked at. But let's run through it quickly. The first point here says the business profits fluctuate due to environmental changes. Sometimes there are new competitors or competition that enters the market. Sometimes government taxes increase or decrease, and that can cause profits to fluctuate. Or sometimes consumer preferences will change. So if there's a new trend, a new phone, a new a product that is competing with yours and consumers switch to that product, that means that it has the potential of affecting your profits. All right. But we are saying that profits generally would rise or losses will go down, will fall if number one, the selling price increases and not too many customers buy elsewhere. That is price inelasticity. Even though we have increased our selling price, it does not affect our demand. So if that is the case, that means that profit will rise even though we have increased our selling price. Then two, it will change our sales volume. That is the quantity sold. If we increase the quantity that we are selling, and if the prices remain the same or remain stable, that means that profits would increase. And then the third one, cost of sales. Cost of sales. If cost of sales or if expenses decline, that is they reduce or they fall, that means that they increase at a lower percentage rate than our revenue. And then number four, if government makes favorable tax changes, normally through reducing rates of inflation, that means that it's also going to increase our profits because obviously the tax rate here in this example, the tax rate was at 25%. So if the tax rate goes down to 20%, that means that our profits will increase. So these impacts is what has been captured in this diagram, that if there are rising profits, rising profits will occur if there are increases in revenue. That is, if there are higher prices or if there are increased sales volume, that will increase the revenue. That will increase our revenue, and also increase in revenue will increase our profits. Increase in revenue will increase our profits. However, if there are lower costs and there is also reduced rates of taxation, that will also means that our costs are reducing, and that will also increase our profits. So this diagram is looking at the things that would affect or cause our profits to increase. Number one, higher prices. Number two, increase in sales volume. And then if these things increase, it will increase our profits. If these things reduce, that is lower cost, if our cost of sales or the cost of other expenses or overheads reduce, that would lead to an increase in our profits. And if the rate of tax also reduces, that would also increase our profit. On the other hand, profit will fall if prices are lowered, if there are lower prices. That means that there's a reduction in our revenue. So if prices are low, like the example we looked at, the example with the bottles of water that I cited, if our prices, our price which used to be $2 per bottle, if we reduce our price to $1 per bottle, that means that our revenue is reducing, and that will also cause a fall in our profits. And then if there are lower sales volumes, instead of selling 50,000 bottles, we are now doing 20,000 bottles. That will cause our profits to fall or will increase our losses. Anything that is causing our profits to fall has a potential of increasing our losses or generate losses. On the other hand, if our costs are high, cost of sales is high, our other expenses are high, distribution expenses, administrative expenses are high, that will cause our costs to increase, and then will cause our profits to also decrease, or our losses to increase. And then if there's increased rate of taxation, if government increases the rate of taxation from 25% to 30%, that is also an activity that can cause our profits to fall. All right. So that leads us to the end of our discussion on the statement of profit or loss. So let's quickly look at the statement of financial position. I think we have some more time. Statement of financial position. All right. So at the beginning, I said that the financial statements will give us the performance and the position of the business. The financial statement will tell us, it's a report that will tell us about the performance of a business in a given period and the financial position of the business in a given period. The financial performance of the business is what we have just looked at in the statement of profit or loss. Are we making a profit? Are we making a loss? So just like we compared it to the report of a student, is a student getting an A or is he getting a B? All right. So how is his performance? All right. Also, we may want to know the position of the student relative to the other students in the class. So in a class of say 20 students, what is his position? Is he top in the class? Is he top of his class, or is at the bottom of the class? Is he the 20th position, or is the 5th position, or is the first position? So this report, the statement of financial position, will also give us an idea about the financial strength or the financial muscle of the business. All right, so let's quickly look at it. It's relatively easier compared to the statement of income or the income statement or the statement of profit or loss. So what is the statement of financial position? A statement of financial position is a financial statement, obviously, which records the assets. It records the assets and the liabilities of a business on a particular day at the end of an accounting period. The statement of financial position records the assets, and assets are what? The possessions, the things that the business owns, the possessions of the business. It also gives us a recording of the liabilities, and these are the things that the business owes. That's the debts that the business owes. All right. So all the things that the business owes, its assets, and all the things that the business owes, its liabilities, is recorded on the statement of financial position. All right. The statement of financial position, as we have said, gives us this picture of the position of the business on a particular day at the end of an accounting period. On a particular day at the end of the accounting period. This is very important because unlike the statement of profit or loss, that gives us the history of transactions that has occurred in the business for a given period. So if the business started trading on January 1, 2024, and the statement of profit or loss is drawn at December 31st, 2024, all the sales of the business that occurred within the year are reported in the statement of profit or loss in the form of revenue. All right. So All the sales from January, February, March are captured in the statement of profit or loss. However, in the statement of financial position, it is giving us the financial strength or the financial position of a business on a particular day at the end of an accounting period. Now, if a business has, let's say, $1 million dollars value of assets at the beginning of the accounting year, that is January, and at the end of the accounting year, the asset it was able to buy more assets, and the asset has increased to $5 million. We are not going to record the 1 million, which was at the beginning of the year. We are going to report on the 5 million assets that the business has now. So it doesn't matter how it started the year or how much asset it had at the beginning of the year. What we are interested in is how much assets does it have today. We are not interested in the position of a student at the beginning of the year. At the beginning of the year, he was paying attention in class and he was top of the class. But we want to know at the end of the year, how did he end? Is he still at the top of the class? What is his position? Is he still first or he has dropped to the 10th position? All right. So just like that scenario, the second point here says that the statement of financial position or the balance sheet is also called a balance sheet, mind you, as we said earlier. It provides a snapshot. So if we take a camera and we capture the assets of the business today, what is the value of these assets? If we take a camera and we capture the value of the liabilities of the business today, what is its value today? We are not interested in the value of the liabilities at the beginning of the year. We are interested in the value or at the end of the accounting period, which is what we stated here at the end of the accounting period. All right. So the statement of financial position provides a snapshot of a business's assets and liabilities at a specific point in time, and it can be consolidated to include information from all divisions. So if the business has branches, if the business has divisions or other operations outside the country, we want to know what is the value of all of these assets in all of its divisions. That is what we call a consolidated statement of financial position. We want to know the value of all its liabilities from all its divisions, from all its departments, from all its branches. All right. And then the other point here says that the statement of financial position records assets and liabilities, and it is showing how capital is raised and used. It records assets and liabilities, and it is showing how capital is raised and used. I will explain more of this point in our next slide. But a very important thing that you need to remember is that the statement of financial position will always show two and three things. All right. The first thing is the assets and the liabilities. All right. The first thing is the assets, and the second thing is the liabilities, and it will also show capital or equity. All right. So I will explain that into more details in our next slide. And then the last point here on this slide says the statement of financial position provides essential information for the business decisions and stakeholders. It provides essential information. It's very important information is contained in the statement of financial position, just like very important information is contained in the statement of profit or loss. At the end of the year, we want to know what is our performance. But we are not only interested in our performance, we are also interested in our position. How many assets do we have? What is the value of these assets? Do we owe any people? What are our liabilities? And what is the value of our liabilities? All right. So these two statements are very important. And I have to emphasize here that whenever we are analyzing a business, whenever we are looking at any business, we want to analyze both of these two financial statements. We want to look at its performance. Perhaps in a particular year, it didn't perform very well and didn't make any profits. However, if you take a look at the balance sheet or the statement of financial position, you realize that, well, even though we did not make any profit for this particular year, we have a lot of assets and it is a very valuable company. So even though we are making losses, the company is still a very valuable company. It has a lot of assets. It has few liabilities. That means that it has more assets. It owes more things than it owes people. All right. So it is very important that when we are analyzing any business, and that is in the other unit, we're going to talk about how to analyze a financial statement. It's very important that we analyze both sets of financial statements so that we can get a good picture of how the business is doing. All right. Now, there are certain key relationships that we have to know on the statement of financial position. Like I said, it will show two very important things. The first one is the assets. What are the things that the business owes? Does he owe land? Does he owe vehicles? Does he own buildings? All these are assets. What is the cash? How much cash does the business have? What is the stock or the inventory that the business has? And what is its value? Now, all these assets were financed with capital. All the assets of a business were financed with capital. How did we purchase the asset? If we have land, how did we purchase it? Did we acquire a loan from the bank to purchase the asset? If we acquired a loan from the bank, how much loan did we acquire? So let's say that all the assets of the business were acquired using loans, and all these assets are $10 million. That means that if we add the cost of the land, the cost of the building, the cost of the equipment, the cost of the machinery, we have $10 million. How did we purchase it? Was it financed with loans from a bank? If it was, then the value of all the assets will be equal to the value of the amount of money we owe the bank. So our assets will equal to our liabilities. I hope that makes sense. That if all our assets are valued and the value of our assets is $10 million, and the question is, how did we come about this $10 million? How did we finance the $10 million? Did we take a loan from the bank to finance the $10 million? If we did, then the value of all our assets is equal to the value of the loan that we took from the bank. However, not all of our assets will be financed with borrowings from the bank. Some of our assets will be financed with the money that the owners of the business contributed. All right, so look at that. So the second key relationship, well, before we look at that, says that this is a fundamental relationship which explains why the statement of financial position always balances. It's very important. It's very important. It's called the accounting equation that on the statement of financial position, it must balance. Our assets must be equal to our liabilities, or our assets must be equal to our capital. That is, if our assets were purchased with borrowings, liabilities, then the value of assets will equal to the value of liabilities. If our assets were purchased entirely from the contribution of our owners, then assets will be equal to equity. Equity is what the owners of the business contributed to the business. All right. So the second one says that the second key relationship that we have to know is that total assets, all our assets, is equal to all our current assets. And we'll define what current assets is later, plus all our non-current assets. That is very important also. And it says that businesses need to invest in a range of assets if they are to operate efficiently. So some of our assets will be current, some of our assets will be non-current. And then the third key relationship that we have to know is that liabilities, that is, the things that the business owes, owing the debts that the business owe, is equal to the share capital. That is the contribution of the owners of the business. Share capital is also equal to equity. Share capital can also be called equity. My marker is not very suited for writing, but let me try. Share capital is also equal to equity, or share capital is also known as equity. So this equity does not belong to the business. It's not for the business. The equity is what the owners of the business have contributed to the business. So it is a liability to the business. So the liabilities are the share capital plus all the things that the business has borrowed, all the funds that the business has borrowed from banks, from its suppliers, etc., and then plus the reserves. So remember that the reserves are the undistributed parts of our profits. So the reserves also belong to the shareholders or the owners of the business. So very important key relationships that we have to know, that assets are equal to liabilities. That is, if all the assets were financed with liabilities, then total assets is equal to our current assets plus our non-current assets, and then liabilities is equal to the share capital, which is equity, plus our borrowings plus our reserves. Any questions here before I proceed?
No questions.
All right. So let's look at the statement of financial position with more details. All right. So we have on the left side here, we have our assets, and then we have our liabilities, and then we have our shareholders' equity here. So all that we are saying, all that the accounting equation is talking about, all that this key relationship that we want to know is saying is that all the assets of the business, whether it is cash or if it has any marketable securities like treasury bills, bonds, etc., if it has accounts receivable, that is the people who own the business, its inventory, that is the stock in trade, the things that the business is selling. If there's bottles of water, the value of the bottles of water, all the other current assets, all the fixed assets, the goodwill the business has, all intangible assets, all other assets, all these, the value of all these assets is equal to the value of its liabilities and the value of what the owners have contributed to the business. So, how were all these assets financed? We have a total of 16,000 assets here on this statement of financial position. 16,000. How did we get a 16,000 to buy all these assets? Now, on the other side, 4,000 was borrowed, and 4,000 was borrowed, and 12,000 is from the owners of the business. That's all we are saying. That the assets of the business will either be financed with borrowings, which is liability, or the contribution of the owners, which is called equity. All right. So very simple relationship that we have to know and understand. The business studies syllabus is not the accounting syllabus. Cambridge has a different paper for accounting, which will go into more details. But in the business studies level or at the business studies level, this is what we are supposed to know. The accounting students will go into more details into these relationships. All right, so let's take a deeper look at assets. We started at 4:30. I think that we should be able to finish by 5:30 or by 5:40 for the interruptions. All right, so let's look at take a deeper look at assets. We already know what assets are. Simply, these are the things that the business owns. Assets are what a business purchases with its capital. All right, so if the business has capital, that is whether it has borrowed the money or the money is from the owners of the business, which is equity, whether it has equity capital or capital that it has borrowed from bank, how were the assets purchased? Were purchased with this capital. All right. So assets are what a business purchases with its capital. And there are two types of assets, just like we saw here. We saw that there are total assets is equal to current assets and non-current assets. There are two types of assets. The first one is non-current assets, and then we have current assets. It's very important that we know the distinction between the two. That is non-current assets and current assets. So non-current assets are assets that are owned by a business that it expects to retain for more than 1 year. All right. It expects to retain these assets. It expects to keep these assets for more than 1 year. We call these assets non-current assets. If you take old textbooks, they will tell you that these assets are called fixed assets. But non-current is a better name to describe these assets. All right. So these are assets that a business expects to retain, to own for more than 1 year. So if a business buys a vehicle, if a business buys machinery, if a business buys land or building, it expects that these assets will be retained in the business for more than 1 year. All right. And it goes on to say that such assets are used regularly by a business and are not bought for the purpose of resale. So the business did not buy these assets to sell them again. There are some assets, for instance, inventory, and we'll look at that when we come to talk about current assets. There are some assets that are bought for the purpose of resale. If we are a shop or a store that sells mobile phones, we will buy a lot of assets. We will buy vehicle, but we didn't buy the vehicle to sell again. But for the mobile phones that we have in stock in our store, we bought it for the purpose of resale. Now, the mobile phone that we are selling is a current asset. However, we are saying that non-current assets are those assets that are not for the purpose of resale and for which the business is expected to use for more than 1 year. And we have looked at these examples. I've cited these examples already. Example: land property, production equipment, vehicles. All right. So remember, more than 1 year. And then we have current assets. This assets or this category of assets is likely, this is the opposite of non-current assets. So these are likely to be converted into cash. They are likely to be converted into cash before the next statement of financial position is prepared or drawn up. All right. So these assets is likely to be sold within 1 year. A very good example is inventory. A very good example is inventory. Cash is also an example of non-current assets. All right, because cash is not kept for any purpose other than to facilitate the acquisition of other assets. All right, so it is likely that we're going to use any cash that we have within the period of a year. All right. So current assets are likely to be converted into cash before the next statement of financial position is drawn up, which means that they are likely to be retained for not more than 1 year. Not more than 1 year. An example is cash and inventory. All right. So it says cash inventory was previously called stock, are examples of current assets as they are only retained by the business for a short period of time. All right, so these are the assets of a business. And then we look at liabilities. This is the opposite of assets. If an asset is anything that the business owns, then a liability is what the business owes. It owes. All right. So a liability is a debt owed by the business to organizations or to individuals. All right. So a business also owes its owners. When the owners of a business contribute or put their money in the business, that money is not for the business. That money is for the owners of the business. And the owners of the business have given the money to the business as a loan, as a debt that the business would have to pay back at a point in time in the form of dividends or in the form of selling of its assets if the business is to close down. All right. The second point here says that another way of thinking about liability is that it shows the sources of capital. Very important. Another way of thinking about liability is that it shows the sources of capital the business has raised in order to purchase its assets. I've explained this already. All right. Also for liabilities, we have current liability and then we have non-current liability. The same the determinants of what current is applies here. So for current liability, they represent debts owed by the business, which is due for payment within 1 year. So any debt that is owed by the business that must be paid within 1 year is a current liability. It's a current liability. The opposite is that if there are debts that a business does not expect to pay within a period of 1 year, then they are non-current liabilities. So there are some debts, there are some owings that the business owns, which are long-term. For instance, if the business takes a loan to acquire some buildings, it will take a mortgage from a loan. All right. And this mortgage takes a very long time, 5 years, 10 years, 15 years. Some can take 30 years to repay. All right. And then some bank loans are also repayable over a long period of time. So current liabilities are those debts owed by the business that is expected to pay within 1 year. And then those liabilities that are non-current are those that are more of a long term in nature. All right. And then I also did mention that equity is also a form of loan to the business from its owners. All right. So equity is the shareholders' stake, is the shareholders' stake or contribution in the business. It's the balance that shareholders would receive if a company sold all of its assets and repaid all of its liabilities. What will be left will be what we know as equity, or what the business owners have contributed to the business. All right. So let me go back to this slide. On this slide, we said that there are some key relationships on the statement of financial position that we have to know. And the first one is what we have explained, which is asset is equal to liabilities, or asset is equal to liabilities plus equity. And we also look at the second one, which is total asset is equal to current asset plus non-current assets. We have looked at all that. All right, so let's expand on this second one, and then by looking at this slide. So net current assets, which we've already looked at. Just a minute, let me go back. All right, okay. So this one was talking about total assets. All right, it didn't say anything about net current assets. So let's look at what we mean by net current assets. Let's look at what we mean by net current assets. We are actually familiar with this terminology. We looked at this when we were looking at the AS syllabus. We discussed working capital um, in our AS syllabus when we're looking at accounting and finance. All right. We said that working capital is the capital available to the business to run its day-to-day activities. All right. So we also looked at the formula for working capital, and we said that it was current assets. And we know now what current assets are. These are assets that a business plan to retain to keep for less than 1 year. All right, to keep for less than 1 year. Example is stock or cash. And how do we calculate net current assets? Is the current assets minus current liabilities. Those debts or owings that the business expects to repay in 1 year. If we subtract the current assets from the current liabilities and we have a positive figure, it means that the business has a positive working capital. It has a positive working capital. It is in a good position to pay its liabilities, its current liabilities. That is, the business has enough assets, cash and inventory, or cash equivalents that can be converted to cash easily to pay its current liabilities. So we say that its working capital position is good. However, if a business has more current liabilities than current assets, it is problematic for the business. And it is one of the causes, one of the things that can lead a business into financial difficulties and eventually into bankruptcy, and then into and then into bankruptcy. And we talked about that in our old syllabus. All right. So net working capital is a very important measure that we will look at when we look at the statement of financial position. It's simply calculated by looking at all the assets that are available to the business and that the business expects to convert to cash easily, or all the assets that the business would be converted to cash before the next statement of financial position is prepared. All these assets minus all the current liabilities will give us our net current assets. All right. And then the second thing that we'll look at is net assets. Please take note of the difference between net current assets and net assets. Net current assets is our working capital. All right. It's calculated by subtracting current liabilities from current assets. But net assets is a measure of the total assets, not only the current assets, but non-current assets as well. The total assets minus the total liabilities will give the net assets of the business. It says that it is calculated by totaling the business assets and subtracting the business the business's total liabilities. All right, so these are important metrics that we are going to look at when we are analyzing the statement of financial position, or what is also known as the balance sheet. Then let's look at the last thing. Let's talk about the last thing before we bring this class to an end. We have several slides more to go, but I don't think we can finish that today. We need another class to finish the statement of financial position. Let's look at reserves. Reserves. Remember, we said that some profits are distributed within the trading period. If trading is successful and profits are generated, some of these profits are paid as dividends to the shareholders of the company. However, some of these profits are also retained in the business, and it is these retained profits that um, will finance future growth of the business. These retained earnings can be used to buy assets and increase the value of the business. All right. So it says that retained profits or reserves are retained profits that is accumulated over time. All right. And the figure for reserves rises, representing a liability and balancing the rise in the value of assets. So the reserves represent a liability. Why is it a liability? The reserves are essentially for the shareholders. It has just not been distributed to them. All right. So if they are accumulated, it represents a liability to the business. All right. Then here it says that retained profits invested in assets, and hence the value of assets would rise. So two important things that represent a liability, and these retained profits or these reserves can also be used to acquire assets for the business. Can also be used to acquire assets for the business. All right. So I think that we can bring our discussion to a close here. Today we've looked at the statement of financial position. We've looked at what it is. We've discussed what it is. We said that it's a document or a report that would record the possessions of the business, that is the assets, and then also the debts of the business, that is the liabilities of the business. And we look at these important relationships on the balance sheet. The very important one is the first one, that is assets is equal to liabilities, or asset is equal to liabilities plus equity. So how are the assets financed? Were they financed with liability, or they were financed with equity? And we looked at a more detailed example, and we've also looked at various types of assets, the various types of liabilities, and then we've looked at what equity is. Equity is also a type of liability. Equity is a type of liability, and we've looked at, very importantly, working capital, which is net current assets, which is different from net assets, And we've also looked at what we mean by reserves. Reserves are the undistributed profits that are kept in the business, and it represents a liability to the business because it does not belong to the business. What belongs to the business are the assets, and then these reserves can be used to finance assets in the future. In our next class, we will look at the format of the statement of financial position, how it is presented, and then we've already looked at this. I have to delete this slide. We've already looked at what current liability and non-current liability is. Yes, it's the same thing here. So current liability and non-current liability. All right, so we'll look at the formats or the templates in preparing the statement of financial position, how it is presented. Remember that when we looked at the format of the income statement, we said that we always start with the sales, with the revenue. We start with the revenue and we deduct the cost of sales, and that will give us the gross profit. We deduct overheads, that will give us the operating profit. And then if there are any interest that is generated, it is added. If there are any interest that is paid, it is deducted, and it will give us the profit for the year. All right, so we're going to look into details how the statement of financial position is presented, and then we'll look at this case study for Mark and Spencer. Any questions so far?
No questions.
All right. So see you. That'll be on Tuesday. See you on Tuesday.
Okay, see you.